All right, welcome to another episode of the Commercial Real Estate Contrarian. I want to talk today about debt and the weighted average cost of debt, weighted average cost of capital, WACC or WACD, depending on what you like. And what I want to talk about is first, I don't want to call out other people or other companies uh, per se, but if you go watch my intro video, you'll kind of get a sense of why I'm doing this anonymously. Short version is because I think that our industry is filled with idiots who don't know what they're doing. And my goal with this series is to help elevate our industry as a whole. So if you go online and you start poking around, you're going to come across a company or website called Bigger Pockets. I want to start by saying that I think that Bigger Pockets is fine. I think that it's good. I think that what they're doing is good. Here's what I want to say though. It's very, very, very basic. They've got this little cute tool input thing online that you can like download, or I don't even know if download, but you enter your deal details into it and you just kind of say, well, how much do you want to put down? I want to put down 10%, and it calculates your loan. That's very, very, very introductory. I mean, that's stuff that they should be teaching kids in high school. But it's just if you're going to be a real estate investor, if you're going to understand numbers and you're going to want to maximize value, you got to understand a lot more than that. I think that they've been doing just fine. And I think that if you followed their plan the last, 7 years, 10 years, you've done really, really well because property values have gone up no matter what. You didn't have to be smart. You just had to have money. So anyway, that's what I want to say about that. And I want to talk about a more advanced level today of looking at the capital stack and looking at your specific debt. So this is an Excel model that I use. As you can see, we're on line 129 here, so I got 128 rows above this of stuff. But I'm going to focus on just this portion right here, which is the debt that I have for every deal. So the first thing that I want to do, I want to look at what the 10-year Treasury is. This automatically pulls, so every time I open up Excel, it pulls the U.S. Treasury rate, and so today it was 3.585. So far, I haven't figured out how to do that automatically, so I need to, figure that out. But I'm not smart enough. So if I would need the SOFR rate, then I go in and manually get it and enter that here. Here we have value. The value is seems like it's pretty straightforward, right? It's the price that you buy it for plus your closing costs. So in this particular case, the deal that we were looking at is 10.35 million. The cost, there is a big difference between value and cost. Cost is the value plus the money that you're going to have to put into it. So if you're buying a single family home, you got to buy it, but then you got to put in a new kitchen, a new bathroom, new carpet. It's all of those extra things. If you're buying an office building, you got to redo the roof, you got to redo the elevator cabs. So your cost is your purchase price plus closing cost, which is value, plus all the capital that you need to put into it. I typically do the first 3 years of capital. You can do the first year of capital, whatever. But value is different than cost. Then I set up different loans. So here's my first loan, my second loan, my third loan, and what I do, anything in blue is what you manipulate. Anything in blue are numbers and cells that you adjust, and then everything else is a formula. So in this particular case, I think that I can get about a 55% loan to value, LTV. Notice LTV, and I just kind of guessed 6 million bucks comes out to 58% LTV. So maybe I want to do 5.75 or something like that. But anyway, so I input that. It automatically calculates the price per square footage because I have my square footage somewhere up above. It also calculates the loan to cost. Remember, this is going to be $6 million divided by 12.8 million because that's my cost. So that's a little bit lower, 46.7. Then my rate, just guessing at my rate right now, but it's about 6.25. talk to some bankers. That's kind of where I feel comfortable. I also like to look at the spread over the 10-year treasury. So all this does is subtracts the rate that I think I'm going to end up paying less the 10-year treasury. Okay. I also like to look at the spread over SOFR. These two numbers are good because I like to know where the spread is. I like to know what my borrowing costs are over the 10-year treasury or over SOFR. Then I have the term. This is adjustable, but typical term for commercial is 300 months of payments, 12 months payments per year. Interest only. I think I can get 2 years of interest only. I'm going to pay 1 point. It automatically calculates this for me. $60,000. This is obviously 1% of $6 million. So the full debt service. This is annually and monthly. That's what these two numbers are. And then I look at my debt service per square foot. I feel that that's important to know. And then my debt yield in year one. And then this is a value add deal. So my stabilized NOI in year 4 is going to be much, much different than my year 1 NOI. And the debt yield is simply the NOI divided by the loan proceeds. So you take, again, your net operating income divided by the loan amount. Instead of net operating income divided by the purchase price, which would be the cap rate, this is NOI divided by the loan amount, which is your debt yield. Banks have gotten away from this a little bit after the financial crisis of 2008. Banks switched to a debt yield instead of debt service coverage ratio. And I'm not going to explain what debt service coverage ratio is in this podcast or YouTube video, but they seem to have gotten away from debt yield now. I'm not exactly sure why, but anyway. So I do this scenario for the entire capital stack of loans. So in this particular case, I've got a first loan at about $6 million. Then I'm going to put on a second loan that's CPACE, commercial PACE, which is, again, I'm not going to explain what PACE is, but if you're doing any sort of commercial deals and there's any sort of value add and you're going to be doing capital improvements, you need to know what a PACE loan is. Very long story short, it's a smaller loan for you to do improvements, and then your loan payments get tacked onto your real estate tax bill. So it's a way of financing capital improvements that are supposed to be green and good for the environment and things like that. So I don't need to go through this again, but notice here, I think that my loan on my PACE is going to be about 7.25. They're in a second position. Now, technically, if y'all understand PACE, you know that they're not. This second loan could be named anything. It could be just a second loan. It could be a mezzanine loan. It could whatever. But in any event, notice though that your rate is going to go up the higher you are in the capital stack. So whoever's in the first position should probably be paid the least amount in terms of their rate. They're the ones that are taking the least amount of risk. And then second, and then third. So let's just say in this particular case, and I added this for the YouTube video sake, but let's say that you still need a little bit extra cash, and you go out to your rich uncle, and he gives you $500,000 to help get the deal done, but he says I want 9% interest. You can amortize it over 300 months. I'll give you 12 months of IO or 1 year of IO, and I won't charge you any points. So anyway, these 3 loans make up my capital stack. Now, what's important or what, at least what I think is important, is this number right here. This is your weighted average cost of capital. This is all 3 of these loans and their weighted average cost. So in total, I've got $8.5 million in loans. And again, loan to value is 82%. Loan to cost is 66%. and then the weighted average cost of capital is 6.65%. Now, the way to do weighted average cost of capital, I know I'm getting into the weeds a little bit here, but I've created a kind of helper set of cells over here. I'm going to make these black so y'all can see them better. Um, but essentially what we're doing is taking the loan amount divided by each loan amount divided by the total the total amount of debt. So in this case, $6 million divided by $8.5 million. So that's your first loan is 70.6% of all of your debt. Now this is not 70.6% of the loan to value or the loan to cost. This is just 70% of all of your debt. This is 23.5% and this is 5.9%. And if I add these up, I hope that it equals 100 or 1. Yeah. So this is just the weighting of each of the loans. And then from here, I take the rate, in this case, 6.25% on the first, and apply it to this 70%. Then at the end, you sum all of these, and then you do another formula. And I'm going to keep this up here for a second so you can see it. And if you want to do something similar, you can. But this is the formula then to figure out your weighted average cost of capital. So 6.65% is my weighted average cost of capital. Now let's say that my rich uncle, this is what I like about this model. Let's say that my rich uncle's like, you know what, I want 12%. I'm the highest risk portion. This is a risky deal. I want 12%. He charges 12%. It really only bumps up my weighted average cost of capital from what, 6.65 to 6.82. Not bad. Let's say that you can talk them back down to 9%. So we're at 6.65. Now, what if my senior lender comes back and they're like, look, we're only going to do we're going to do a much lower loan amount. We're going to do $5 million. So $5 million, my weighted average cost of capital goes to 6.7% from 6.65. Still not a big deal, but what if they want to charge me now 6.75%? Now I'm starting to kind of creep up. Now that was a pretty big jump in terms of my weighted average cost of capital, because remember, changes to this loan right here, your first loan, this is going to have more of an impact on this weight, or on this weighted average cost of capital, because it's the largest chunk of your debt. So, and then below, I just for my own analysis, I've got debt service coverage ratios for my first loan. And then this is pulling from year 1, 2, 3, 4, 5, all the way through 10. It's pulling your NOI divided by your debt service coverage, and this is your debt service coverage ratio for all three loans, and then your total debt service coverage ratio, and then I also have debt yield for all three of my loans, and then the total for each as well. So this is a proper way to analyze your capital stack. This is not simply saying, oh, I'm going to buy with 10% down and I'm going to get a 90% loan. That's great if you want to be a very, very basic investor, and that's great in a rising market. But if we get into a situation where property values don't always go up, and you actually have to know what you're doing, and you have to analyze this sort of stuff and present it to a lender or present it to an investor, and they ask, well, how much debt is on the property now? What's your weighted average cost of capital? And you say you don't know, good luck to you. So this is my way of doing it. If y'all have a different way of doing it, I would love to see or hear about it. So that's my take. Thanks, and hope this was useful.